Simon, just to you, good morning. When we just flip back into Stockland, I'm looking at, for investors, a strategy here where the dividend looks to have been shaved for full year 2010, down from 17 cents back to just on 11. And yet they're talking out into the future about growth profile now looking fairly well intact, and certainly looking to capitalise on growth opportunities. The revenue numbers are good, so demand's there. How do you play it as an investor when you see your dividend though shaved?
Yeah, good question. And again, I haven't looked too deeply into those numbers. I think in general we're seeing, across the board, organisations or industries trying to squeeze additional efficiencies out. Here in Australia, we've got a slightly better positioning than maybe some of our counterparts, offshore and overseas, in that the market and consumption's slightly better. We're seeing some results coming in, potentially better than expected, but interesting that they're squeezing back on some of those dividend payments there also. So I think just it's in terms of an investor's outlook, I think it's a cautious optimism, and I think they're trying to keep their cards a little bit close to their chest there.
Without getting too technical as well, it looks as if they're announcing today a change to their distribution policy. Just something for investors to flag, talking about distribution greater of 75% underlying profit or trust taxable income. Can you put that into layman's terms for investors? What does that mean? Sounds like they're going the way of Westfield.
Yeah, well, I think, look, in general, it's a very big week for the retail investor this week. We've got, Stockland, obviously, CBA we heard from this morning, Qantas and Telstra also reporting this week, and most of these names tend to be staples of most, Australians' portfolio. So a very big week for the retail investor. Yesterday also some encouraging, some good results from the likes of the retail sector as well. JB Hi-Fi, Harvey Norman, both up over 2% there as well. So an interesting week, I think, across the board for those investors looking at their portfolios and looking at being potentially a little bit more selective about what they put in, not across different sectors, but also within those sectors as well. There is understandably a little bit of a bearish concern about the second half of this year, and that's understandable going through the global downturn that we've been through. But there is a growing momentum or sea of those investors willing to look beyond that and recognise that in a lot of the firms we've just mentioned, there is potentially quite a bit of pent-up demand and quite a bit of spare capacity there as well. We saw that with our CPI figures a couple of weeks ago that didn't shoot to the top side, and one quick look at the Baltic Dry will tell you that as well. So that's a great combination. When you've got some pent-up demand and a lot of excess spare capacity, potentially very good buying opportunities in some of these firms that are cautiously optimistic about the future.
Where's the kind of master plan / blueprint though for the next phase of growth here? They're talking about Asia, but in only kind of very generic motherhood statement terms. There's no commitment to getting a foothold there. How important is that?
No, I'd agree with you, and certainly it's got to be on their agenda or on their shopping list. But I think more importantly, it's about bedding down, what's going on in your backyard. We mentioned on the Tier 1 capital structure of our bank, CBA, and the big four in general here. They're adequate. They're okay. They've weathered the GFC a lot better than banks across the globe, and they've been able to do this by adjusting their capital structure more away from that reliance and that dependency on those wholesale money markets and more on off-balance sheet lending and domestic, which is why we're seeing all these A-frames for a while now outside the front of the banks promising us these great interest rates on our term deposits. Conversely, at the same time, it means though that those borrowing costs are quite high as well, and that spread between the cash rate and say our variable mortgage rate is quite different. And lastly, what's starting to feed back in as well is that through the GFC, a lot of large provisions were made, for defaulting loans. Even though we didn't really have a subprime or exposure to a subprime market here, they still made those provisions. Obviously, they didn't have to pay up. The delinquencies haven't been there, so a lot of that's coming back onto the balance sheet, and it flows directly through the bottom line. So it is a great result, and I think we're going to see some good results from our big four. Interestingly for me though, is to have a look at the next one behind, which is a little old Bendigo Bank with St Georgia folding into Westpac now. There's that big hollow middle, and you've got to look at those little banks like Bendigo Bank having a great result. Why? Because it's sitting nicely in the slipstream potentially of those big four.
Perhaps a shift for the Fed. Only months ago they were debating how they wind up the various stimulus programs. Just weeks ago, Ben Bernanke was saying they wouldn't really do anything unless things really worsened appreciably. Have things worsened to the point where QE2, as we've been saying on the channel this morning, Simon, is actually the ultimate destination, the inevitable destination?
That's a good question, and as a follow-up, I'd be happy to talk about potentially why their rationale for this QE2 might drive into the employment and the housing market, which was something that Carson was speculating on earlier. But you know, my response to that is, look, I think it's extreme. You're right. They were avidly debating how they were going to be reducing some of this unprecedented stimulus. For me, it seems like a complete turnaround. It's like the Fed saying, look, everyone stand clear, we're going to come in with a defibrillator. So it seems like a nervous or a bit of a knee-jerk reaction to me. I don't think the US economy is in cardiac arrest. I think certainly that it's losing some steam and it's slowing down, it's losing a bit of momentum. You know, I may be missing something. In a practical sense, what does that mean? For a trader, if you take that duration risk out of that yield curve, they're impartial as to where they buy along that curve. And in layman's terms, what that means is that they're going to go for the longer dated stuff, that it's going to start to look more attractive because of the higher yield. Now, against a backdrop of deflationary risk, or the risk of deflation, I think effectively what the Federal Reserve has just done is they've just shown their hand to the rest of the poker table, if you like. They're basically saying rates are on hold for a long while now.
Well, the problem is that their hand has been a pretty grubby fake one, hasn't it? I mean, they've bought up $1.7 trillion worth of treasuries to date. Mortgage rates have only fallen by 0.5% on the back of it.
Exactly, and it's very interesting. And when you've got a benchmark rate of 0.25%, what else can you do but throw harsh words at it? You know, it's sort of hollow. Look, it's interesting. So they're funneling some of the proceeds from these maturing mortgage bonds into longer-term, longer-dated debt. What are they trying to do? Reinvesting that, they're hoping for a bit of price stability. But what they're trying to do is bring down those market-set borrowing costs, which is what you're talking about. The US investor is still telling us that those market-set borrowing costs are still too high. Why? Because the household sector isn't buying any houses, they're not taking on any mortgages.
But those mortgage rates are at their lowest level since the 1950s.
Yeah, but I think for the US investor, they're still too high. When you look at the amount of value that's depreciated in that asset as well, it's making them way too nervous. For the business sector as well, which is all important, I think, for driving this consumption-based economy, businesses are not borrowing to grow and expand, and they're not putting on jobs. We keep talking about these unemployment levels at 27-year highs. It's a symptom. It's not a cause, it's a symptom. And it's a symptom of the fact that the business sector is nervous about increasing employment.
And thanks, Simon Mariner from Aliom as well.